Hi, my name is Megan Sauls. I will be reporting on the financial analysis of Ulta Beauty Inc. The past two quarters of Ulta Beauty Inc.'s reported financials indicate that total assets and liabilities and stockholders' equity decreased by 2.6%, which can primarily be attributed to a decrease in cash and cash equivalents. However, accrued income taxes decreased by 100%, while prepaid income taxes increased by 100%, implying that this balance was paid from the previous quarter. Additionally, inventories increased 6.7%, which may suggest that the business is struggling and may warrant further analysis. Although Ulta experienced a decrease in total assets, net income increased 9% from the quarter ended May 1st to the quarter ended July 31st. This demonstrates that Ulta was able to control its cost of goods sold and experience a decrease in this expense even though net revenue increased by 1%. Ulta also realized interest income instead of interest expense, indicating that the interest earned from investments like bonds and savings generated more in revenue than the company paid to lenders. This reflects positively on the financial health of the company. A vertical analysis of Ulta's balance sheet reinforces the horizontal analysis of the balance sheet. First quarter records cash and cash equivalents as 18% of total assets, whereas the following quarter records this asset as 15%. However, merchandise inventories increased from 26 to 29% in the second quarter. This demonstrates that although current assets remain stable at 50.4% of total assets, the composition shifted. This shift is important to note because it affects liquidity ratios since inventories are not a near cash asset. This composition shift may make it more difficult for Ulta to pay its short-term debt obligations. The common size income statement for Ulta also shows little change in income and expenses. The only notable change is a small increase in net profit margin. Despite Ulta's realized increase in net profit margin, the company continues to perform considerably worse than its competitors in the cosmetic and beauty supply industry, who achieved an average of 43.8% in 2020. Compared to industry averages for 2020, Ulta is performing worse in all ratios except for the current ratio and interest coverage ratio. However, when compared to its own previous quarter, Ulta performed better in all areas except solvency, which measures the ability of the company to remain profitable for the duration of its long-term debt. As a company, Ulta was performing well when taken out of the context of its industry. However, an investor should be concerned about Ulta's financial performance against its competitors in the industry, who may offer a higher rate of return. Ulta is not turning over inventory quickly enough, which may indicate that it stocks obsolete inventory. Additionally, its net profit margin is considerably lower, which it primarily attributes to costs related to the pandemic. Additionally, the return on assets is less than half the industry average, indicating that the company may not be deploying assets effectively to generate revenue. Although Ulta appears to be performing well from first to second quarter, the company is struggling to achieve ratios near the industry averages realized in 2020. Ulta appears to be recovering from the pandemic as stores increase capacity, extend hours, and begin offering additional services, but it is well behind its competitors. Investors should continue to expect an increase in return on stockholders' equity as net revenue continues to increase. So, although Ulta is struggling against its competitors, it is becoming more financially stable and profitable as a company.